When a company sells a product, each sale brings in revenue, but not every sales dollar remains after variable costs. Start by separating variable costs from fixed costs. Variable costs change with the number of units produced or sold, while fixed costs remain constant within a relevant range of activity. Contribution margin is an accrual-based analytical measure, sales revenue minus variable costs. It is available first to cover fixed costs and then to produce operating profit. It is not a cash balance because revenue and costs may be recognized at different times than cash receipts and payments. Contribution margin per unit equals selling price per unit minus variable cost per unit. It shows how much one additional unit contributes first toward fixed costs and then toward operating profit. The contribution margin ratio expresses the same idea as a percentage of sales. Divide contribution margin per unit by selling price per unit, or divide total contribution margin by total sales. Here is a worked example. Suppose Harbor Mugs sells each travel mug for $20. The variable cost is $8 per mug, including materials, packaging, and a sales commission. Contribution margin per unit is $20 minus $8, or $12. The contribution margin ratio is $12 divided by $20, which equals 60%. In other words, each mug sale leaves $12 of contribution margin, and 60 cents of every sales dollar remains after variable costs to help cover fixed costs and profit. If Harbor Mugs sells 500 mugs, total sales are $10,000 and total variable costs are $4,000. Total contribution margin is therefore $6,000, calculated as 500 units times $12. If monthly fixed costs are $4,500, the remaining $1,500 is operating profit before other items. Contribution margin supports planning, pricing, product mix, and short-term decisions, but it depends on sensible assumptions. Review the selling price, variable cost behavior, relevant activity range, capacity, and other business conditions. A higher margin does not automatically make a product best if it uses scarce capacity or creates other costs. Use this accrual measure as a decision tool and analyze cash flow separately when timing matters.